Multiple major outlets report SpaceX has confidentially filed for an IPO. If true, the listing will immediately reprice the entire global space sector. This shift transforms orbit into an industrial layer, supporting everything from global defense networks to the world's data backbone. Last year, the global space economy reached $613 billion, with 78% driven by commercial activity, spanning communications, defense, and orbital logistics. SpaceX's rumored $1.5 trillion valuation means this single company is worth more than double the entire industry's current size. A SpaceX listing creates an inescapable anchor. Every other launch provider and satellite operator will now be valued relative to this one entity. Many will treat this IPO as a green light to buy any space-related ticker, but that approach ignores the specific risks of this valuation. A $1.5 trillion price tag is not a reflection of current revenue. It is a massive down payment on years of perfect execution before anyone has seen the public financial disclosures. To justify that number, investors are banking on unproven revenue streams, global direct-to-cell monetization, the untested economics of Starship, and speculative AI infrastructure in orbit. There is also significant governance risk. This entire infrastructure platform remains tied to Elon Musk and the capital allocation of his various adjacent entities. An alternative strategy is to focus on the second-order beneficiaries. These companies gain from the new valuation benchmark without requiring a trillion-dollar market cap to succeed. The goal is to identify the companies that win as SpaceX scales, while avoiding the legacy players whose business models are being actively dismantled. This matrix maps the industry by two metrics: a company's growth potential and how much they depend on SpaceX's dominance. In the top right corner, we have the monopolistic leader. SpaceX maintains full-stack control over both launch cadence and satellite broadband. While SpaceX is a strategic necessity, its priced-for-perfection valuation makes it a difficult entry point for tactical investors. Just below are second-source challengers. Governments actively fund these alternatives to avoid dependence on a single provider. Rocket Lab has positioned itself as the next best platform. They have transitioned from small launch to defense systems, supported by a $1.85 billion backlog. For investors focused on infrastructure beyond launch, Intuitive Machines offers high torque to lunar services and cislunar data relays. These challengers offer better relative value, but they come with mission-specific risks. At this scale, a single technical failure can immediately disrupt their financial timeline. The third quadrant is defensive yield. This is where you find stability in a sector usually defined by volatile constellation buildouts. Iridium is a cash-generating business. They provide mission-critical government and IoT connectivity that doesn't overlap with Starlink's consumer broadband focus. These assets provide a portfolio floor, but lack the high beta upside of launch providers. They will likely lag during an aggressive sector rally. Finally, the structural losers. Companies whose business models weaken as SpaceX dominates. The market is shifting toward low Earth orbit architecture. Customers are abandoning older models for the lower latency and higher speeds these new networks provide. This shift puts legacy incumbents like Viasat in a difficult position. They face intense pricing pressure and shrinking margins against a technologically superior benchmark. Pre-revenue operators like AST SpaceMobile face a similar hurdle. They are attempting to build out a massive constellation while competing directly against a SpaceX rollout that is already commercially active. Holding these subscale or legacy operators is a risk, as their fundamentals will face harsh comparisons once SpaceX's metrics are public. The SpaceX IPO formalizes the split in this sector. It highlights the vast fundamental distance between next-generation platforms and the companies still struggling to adapt. If you are following the retail hype, the most practical step is to wait for the public S1 filing. You need to see the actual recurring economics of Starlink before committing capital. Buying the IPO at a $1.5 trillion valuation without those disclosures leaves you with no margin for error if the growth slows. For thematic growth, the better entry points are the secondary challengers. Rocket Lab and Intuitive Machines provide the most direct exposure to space infrastructure. If you are risk-averse but want more exposure, look toward Iridium. Their focus on stable, specialized connectivity provides a defensive hedge against the more speculative names. Survival in this sector rally requires matching your risk tolerance to the specific business model, rather than buying the whole theme indiscriminately. Advanced investors can remove the directional guesswork by focusing on relative value between the winners and losers. This is best expressed through a pair trade. By going long and short simultaneously, you can isolate the space thesis from broader market volatility. The long side focuses on Rocket Lab, rewarding its role as a disruptive prime with a growing defense backlog. The short side focuses on Viasat, penalizing a legacy operator that is exposed to the pricing pressure of new satellite architectures. This structural trade doesn't depend on SpaceX's stock performance. It relies on the widening gap between modern and legacy business models. Boating the space economy requires moving past the central hype. The most effective trades rely on identifying the companies that reinforce SpaceX's infrastructure rather than those being replaced by it.